Okay. Welcome to our fifth session of Tax Foundation University for 2017. Today's key points are going to be how we balance our tax changes among our major goals of growth, distributional concerns, revenue needs, and simplicity. This requires awareness of the trade-offs among some of these features. There are interactions, and sometimes they come into conflict. We need to be careful in using the tax expenditure lists in designing tax changes, and I'll go over some of the reasons why. And then we'll do some dynamic evaluations of some current tax plans and proposals. We've talked before about these trade-offs between revenue neutrality, distributional neutrality, and making a tax system pro-growth. These are the most common goals. It helps if you use dynamic analysis, if not dynamic scoring, when you're putting together a plan. Dynamic gains from growth can relieve you of some of the revenue loss that might occur from a tax reduction. It may also restore some of the distributional balance that you might favor. In particular, if the tax reform raises productivity and wages, that ought to be considered, but the distributional tables that you normally see don't bother taking account of those dynamic changes in wages and pre-tax income. Now, of course, how much of these things occur depend on the type of tax changes involved. They're by no means all the same. Some are more growth-oriented, some do more for wages and productivity than others. Now, simplification is a common additional goal to the three main ones. We often see people talking about fewer brackets being a simplification and eliminating deductions being a simplification. These generally have less to do with growth than with ease of compliance or ease of administration. And these days, with the tax tables available to you and the software available to you, the number of brackets really does not matter that much. What's much more important is what rates are applied. A simpler tax system does have one good advantage from a political economy standpoint. It makes taxes more transparent and more understandable and reduces concerns about equity and avoidance. If everybody understands the tax system, then you can be pretty sure that your neighbor isn't getting away with something. If you don't understand the tax system, you may have the lingering suspicion that you're the only one paying the tax, and this leads to hard feelings. Nonetheless, I should point out that the growth and simplicity goals really do act more or less hand in glove. A neutral or a savings consumption neutral tax is much simpler than an income tax, and it's less destructive of growth as well. If you took a look at David Bradford's book, Blueprints for Basic Tax Reform, he lays out side by side a kind of scrubbed or purer income tax and a consumption-based tax that is paid on a personal tax form by subtracting saving from income. And if you look at them side by side, you see that one is a great deal simpler than the other. And they can both be made progressive with graduated rates and exempt amounts and so on. But that's a very good book to study if you want to see the two tax systems side by side. We'll put together a reading list, by the way, and put it on the website for you. Now, when you put together a tax reform plan, some of the elements of it may be more growth-related than anything else. These include such things as the cost recovery rules, the tax rates and brackets, and how you're treating saving. Is it multiply taxed, or is it given the sort of treatment we give pensions? And then you get into the multiple taxation issues. Now, just because they're growth-rated doesn't mean they can't be simplifying the situation. The expensing provisions in most of the saving consumption neutral tax systems are a great deal simpler than having to keep track of depreciation and recapture and all of those complex treatments of plant equipment and structures. Then we have the provisions in a tax reform plan that are mostly related to distributional neutrality or social policy objectives. These include exemptions, deductions, credits, perhaps the tax-exempt status of certain tax-exempt entities, the treatment of municipal bonds, and so on. Then there are the simplification-related policies. We've seen a number of proposals that have attempted to consolidate overlapping provisions and deductions, the number of brackets. For example, we have a whole bunch of policies relating to retirement income. We have a half dozen retirement saving plans. And then there are the duplication in child credits and some of the educational credits and policies. Now then, of course, there are the pure rate provisions. The rates, the base changes affect those. And then there are the offsets. When you're designing a tax cut that is relieving the tax on investment through faster cost recovery, for example, you may need some offsets to cover a portion of the cost in the first few years. And ditto on corporate rate cuts. You have to be careful what offsets you pick. You're going to want to pick offsets that don't damage growth because you want the growth effects of the other policies to shine through and not be offset. One instance I'll point out was that during the Camp draft, where they were trying to stick with a broad-based income tax and merely rejigger it to be more pro-growth, they made up for the revenue loss of cutting the corporate rate by lengthening the asset lives. And the asset life increase did more damage to growth than the rate cut did to promote it. And we scored the plan as showing 0.2% additional GDP over a decade. That's in total, not year by year. And the only growth came from lowering the individual rates in that bill in our model. If you're going to start off with a tax reform, you really should start off by asking yourself, what kind of tax system are you aiming for? Are you aiming to clean up the income tax, or are you aiming to shift to a neutral base? Or are you willing to keep the current hybrid with some provisions that reflect each type of tax? And be careful, because depending on your answer, some of the things on the ordinary tax expenditure list may or may not be appropriate to include. Some things are appropriate on that list if you want to get rid of them to stick with the pure income tax. But in some cases, you might find that the provision in the current law that's branded as a tax loophole against an income tax would be considered, in fact, an inadequate deduction against a consumption-based tax. Well, let me give you an example. Again, the depreciation schedules. In a consumption-saving neutral tax, you would have expensing, so depreciation is too slow. But in a pure Haig-Simons income tax, you would have long depreciation lives reflecting what is called economic depreciation. And anything faster than that would be considered accelerated and would be considered a loophole. So in one case it's too small, in the other case it's too large. You have to keep these things in mind. And of course these things have growth effects. In particular, we're tempted to use the tax expenditure list, but joint tax warns us not to do it. You shouldn't do it for scoring because it's affected by timing issues, transition issues, and interaction issues. You should not include provisions that conflict with other features or objectives of the plan you're trying to reach, and in particular consider the economic effects of any of these potential offsets. The other point, which I made a moment ago, is you should consider the growth and wage effects of the proposals you're dealing with and count that toward whatever distributional calculations you're making. If you're going to be raising people's wages, they are getting some of the benefits of the tax reduction, even if the persons who are sending the checks into the Treasury are another group that are, for example, a business that is now able to save some money and buy new machinery. You might think, well, that's where the tax break falls, but if that means more employment and more wages, a portion of the benefit is going to the workforce. Growth is important. The workforce captures pre-tax almost 2/3 of the GDP, and capital gets about 1/3. After taxes, the labor force gets about 50% of any growth. The governments, federal, state, and local, get close to 1/3 or 35%. And the capital returns are about 15%, but about 10% of that goes to replace worn-out machinery, and you've got about a nickel going to the savers. Returns to capital are highly competed away, and the beneficiaries are generally the workers who get the higher wages. Again, depreciation, limited pension and saving provisions, reduced tax rates on capital gains and dividends, all of these are tax expenditures on a pure income tax, which has that second layer of tax on saving and requires long asset lives. But these are inadequate offsets to double taxation under a saving consumption neutral tax. In that situation, you would not want to double tax the corporate income, and you would want expensing rather than depreciation. Let's talk a moment about some of the other major deductions that people like to play with or think about keeping or getting rid of in tax reform in the effort to broaden the base and lower the rate. Charitable contributions are controversial. A lot of people keep them. Herb Stein used to say that charitable contributions were payment for the eleemosynary services of the poor who deigned to take your income and made you feel better because you have given it. So he didn't want to deduct the charitable contribution because he didn't want to tax the recipient, but he thought it should be taxed. In a tax system such as Norm Ture put together, where his rule was, if it's taken from me and given to somebody else, it comes off my tax return and goes on to theirs because they get to spend it, then a charitable contribution should be deductible. And the recipient, if he's too poor to owe tax, should not pay tax because Congress has deemed him to be too poor to be subject to the levy. State and local tax deductions are also controversial. Some conservatives suggest that they are a subsidy to big spending states and we ought to knock them down. Some liberals complain that it's a valuable deduction for the upper income and it's costing the government revenue. You kind of have to figure, are these taxes aimed at supporting consumption, or are they in fact transfer payments to someone else? Insofar as they go to Medicaid or welfare, it's coming off the individual's return, who is the taxpayer, and going on into the income of the recipient. And under the transfer concept, it should be deductible. A large portion of the state budgets go to Medicaid and to the, nowadays. Then there are the local taxes. In a pure cash flow, saving consumption neutral tax, we have to figure out what we're going to call education spending. Is education spending a payout to gain the training and the skills with which to earn higher income? If that is education, then this is an expense to earn higher income. It should be deductible, just the way machinery or buildings should be deductible, and then you should pay tax on the higher income. When you get down to the local government level and you have over half of the budgets of many local government entities going for the public schools, you have to ask, well, isn't this another case of a good reason to deduct the property tax because it's going for education? Then you have the question, are they good schools or bad schools, and wouldn't you want to read even if you weren't going to be working for a living? Even at the college level, if you take a class that's going to further your career, that's one thing, but if you're taking a class in art or literature that you're not going to be using for your work, is that not simply enjoyment? Education is always a gray area. I'm just pointing out that some of these deductions and issues are not as clear-cut as they might otherwise seem. There's another issue with state and local taxes. The high tax states are generally also the richer states, but they're also generally the higher cost of living states. So when you have people in New York, say, getting a big state and city deduction for income taxes, the government in Washington is losing some revenue, but this is being paid out to civil servants in New York who are generally higher paid than civil servants in other states, and they're in higher brackets, so we're getting more back at the other end. And getting a net idea as to how this plays out is not easy. And so I don't do it, but you're welcome to try if you want to. Let's take a look at a couple of plans that have already been submitted by members. This is the plan of Representative Nunes, Republican of California, and his goal here was to reform the business side of the tax system, figuring that might be easier to do than trying to do all of it at once. He has a corporate income tax rate of 25%, down from the current 35%. He would keep the non-corporate business tax rate capped at 25%. It would not go up to the top bracket rate. To make it equal to the corporate rate, he allows full expensing of investment in equipment, plant, and structures, and he moves to a territorial tax system. Let me say a word about keeping the pass-through tax rate and the C corporation tax rate identical to avoid people switching forms. There's another element you have to keep in mind, and that is that the shareholder is paying tax on the dividends and reinvested income that gives capital gains in the C corporation sector. So the combined tax rate is higher than the C corporation rate, and there's no reason not to have that much differential between the two rates to even out the tax treatment of the two types of investment. You might get pushback on that from some of the pass-through people, but you still have to remember that shareholders matter. However, the Nunes plan, with its expensing and lower corporate rate, is extremely pro-growth. He gets about 7.3% additional growth according to our model by the 10th year. The stock of plant and equipment in the business sector would be increased by about 22%. The wage rate would be up by about 6%. There'd be additional hours worked equal to about 1.4 million jobs. The static revenue estimate for this plan is about 1.6 trillion. But after you get over the hump on the expensing and the old stuff gets depreciated out and the cost of the expensing goes down, and as the growth comes in and payroll tax and income tax revenues go up, you find that over the 10-year window we find actually a small increase in receipts. Much of that in the last part of the period, of course. There's a hole in the budget in the first 5 years, surpluses further out. Now, I made a point about watching out for what happens to wages, because if a tax plan is going to lift wages, and you take account of that on a dynamic basis, you get a better idea of the ultimate real distributional effects of the tax change. Here we have the change in static after-tax adjusted gross income without taking the growth into effect. You see the plan is weighted more toward the top because of the changes in business taxation. But when you take the growth into effect, you've got a fairly even growth rate. You have about a 6 or 7% increase in after-tax income in most of the decile classes of the income distribution, and that's because of the wage hikes. The next plan we'll look at is by Senator Cardin, Democrat, Maryland. He's proposing lower individual and business income taxes, doing both sides of the tax system. And he would replace some of the revenue lost by his growth provisions by bringing in a sort of value-added tax. It's called a personal consumption tax. It's sort of like a value-added tax, except instead of having it collected at every stage of production where the business pays the tax on its sales and then gets a rebate for the tax on what it bought, it simply takes the difference between those two numbers and only pays the tax on the difference to begin with. It's much easier for the business to deal with in an administrative and compliance way. It doesn't leave as much of a paper trail for the Treasury to check to see if the people down at the bottom paid their share of the tax. And so it's a different style of VAT than the one the Europeans use, because they want the private sector, in effect, to be policing itself so that they don't have the added compliance costs. But it's the same type of tax. It's border adjustable. It's not levied on exports. It is levied on imports. Now, his plan would have very large family allowances to make a good start at keeping the plan roughly as progressive as the current tax system. The large family allowances would be $100,000 for a joint return and $50,000 for a single return. You can see that a lot of people would not be paying the income tax under this system. They would be paying the personal consumption tax, but not the income tax. In the levels of income that are subject to tax, he has 3 brackets of 15%, 25%, and 28% for amounts over the exempt amounts. And he would have 3 deductions for charitable giving, state and local taxes, and mortgage interest. By the way, his personal consumption tax would not fall on the government sector, only on the private sector. Many VAT-ish type taxes fall on the wages and salaries of government workers in addition to the wages and salaries of non-government workers. But in this particular plan, he leaves the government out. He would replace a number of the credits in the current system with simpler ones, but there would be 3. The EITC and the other credits would be replaced by rebates for earned income and 2 for children. And those, of course, are intending to, again, maintain the current distribution of the tax burden as you see it in the current distribution tables. He would treat capital gains and dividends as ordinary income, but he would end that pesky 3.8% surtax that was enacted to sort of match the Medicare tax on investment income a few years ago that the Congress is considering now with the discussions over healthcare reform. That would increase taxes on capital gains and dividends. That would partially offset the growth effects of the lower corporate rate. He has a rate of 17%. He does not deal with expensing. The lower corporate rate is carrying the burden of growth without the benefit of accelerated depreciation. And the VAT that he's putting on at 10% would be the subtraction method. It would have to be about 14% to be revenue neutral for the whole plan. He's perfectly willing to adjust plans to deal with revenue concerns by the committees, but he just, as a first guess, had chosen 10%. With the VAT at 10%, you would get about 4.4% growth out of the Cardin plan, and about 2.6% if the VAT were raised to make the plan revenue neutral. Excuse me. The wage rate would be substantially higher, and you would be getting close to a million jobs with a 10% VAT, not so much with the higher one, which raises taxes a bit on labor. The cost is difference is pretty dramatic because of the growth effects. The cost on a dynamic basis is considerably less than the cost on the static basis. And at the higher VAT, you would actually be raising revenue in the long run. This is the outline of the Ways and Means blueprint. It overlaps a lot with some of the provisions in the Nunes plan, or the other way around perhaps, because the blueprint was well underway when Nunes started working. But the individual provisions would consolidate 7 brackets into 3, rates ranging from 12 to 25 to 33%. The standard deduction would be increased to $12,000 single and $24,000 married, while eliminating the personal exemption. It would increase the child credit to $1,500, but limit the refundability to $1,000. It eliminates all itemized deductions except the mortgage and charitable contribution deductions. It taxes capital gains and dividends as ordinary income with a 50% inclusion rate. 50% would be excluded. This is the way we used to do it in the 70s. And eliminates the AMT and estate taxes. You can see that with the elimination of the estate tax and the continuation of a differential with the capital gains and dividends, you're whittling away at those multiple layers of taxes on saving and investment that we looked at a couple of weeks ago, trying to reduce them. On the business side, it eliminates the corporate income tax and replaces it with a destination-based cash flow tax, which is border adjustable, like a VAT. So I sometimes call it a BAT, a border adjustable tax, and others call it a business activities tax. They both have BAT as their initials, so I tend to fall into that pattern. It allows immediate full expensing of plant, equipment, and structures, and they do something rather clever. One of the problems with taking expensing, if you're a startup business, for example, or a business growing very rapidly, is that when you're putting up buildings and other very expensive projects, you may have such big deductions for the cost that they exceed your current revenue. Now, your revenue may increase over time as you get these things built, but right now you can't take the deduction. And there are limitations on the use. Currently, you can carry the deductions back 2 years or forward for 20, but if you can't use them after 20 years, you lose them. And if you do have to carry them forward, you run into the same problem as with depreciation. Having to take your cost later means it's not as valuable a write-off, and you're understating the cost of the asset. Well, the blueprint would scrap the carry-forward limit. You can carry it forward as far as you want to. And if you did have to carry it forward, they would adjust it for inflation and the time value of money, roughly 3%. So if you had to wait a year and inflation were 2%, you'd get a write-off that was 5% larger. And if you had to wait 2 years, it would be 10% larger, and so on. So the value of the write-off is maintained in real present value terms, even if you're a startup and you have to wait. That's one way of dealing with the startup issue or a rapidly growing company. There is another way of doing it, which was in the Touré cash flow tax I showed you 2 or 3 weeks ago, where the saver or lender to the firm gets the deduction because the saving is deducted, and the firm takes that into income, buys the machine, doesn't pay tax yet, but does get a break when he pays the original lender back, who then has to pay tax on that. If you do the arithmetic, you find it comes to the same thing, and the deduction is able to be taken by the original lender right then without worrying about net operating loss carryforwards. If you're going to do it at the level of the business, you do have to make these other adjustments that the blueprint makes to handle these net operating loss carryforwards, and the same problem arises with the Hall-Rabushka flat tax because all of these things are still handled at the business level and not passed on through to the owner. But in any event, it's a very clever way of dealing with it. The blueprint eliminates the deductibility of interest on future loans, not past ones, and it does continue to tax the lender. So you end up putting the double tax on interest on capital gains and dividends onto the debt side. It evens out the treatment of debt and equity, but it does raise the cost a bit on debt. However, because interest would only be included at half of the amount flowing in, just like capital gains and dividends under this plan, the damage is not quite as big as if you left it treated as ordinary income at the full tax rate. I think that provision was partly included because of the fear that they would run afoul of the Byrd rule in the Senate. This particular provision raises a lot of revenue in the out years. It starts very slowly because it's only on new debt, not on old debt. And it builds and builds and builds and gives you money beyond the budget window to make it less likely that you would run afoul of the rule in the Senate, which says you can't have a permanent tax change that will lose money beyond the budget window. Some other people are saying, well, let's extend the budget window 20 years because some other provisions will get us paid off by then. And you've got this other idea about how to get around the Byrd rule. But whatever the Senate decides, it's up to the Senate. I would suggest that the rules that you bind yourselves with here have made spending changes, entitlement changes, and tax changes, and general fiscal policy operations so convoluted and so difficult that you really are kind of freezing action, even when it's important, which is unfortunate. The blueprint would cut the corporate tax rate to 20%. And eliminate most corporate deductions except for R&D, and eliminate the corporate AMT. It moves to a fully territorial tax. It stops taxing earnings of companies abroad and focuses the tax on the earnings of the company in its domestic operations. This is an enormous simplification, and it goes a long way toward reducing the incentive to invert or move your headquarters abroad so as not to have to pay tax twice on foreign operations, once there and once here. Now, of course, some of that incentive is taken away if you lower the corporate tax rate to 20%. There is still a little bit of incentive to do business or to move your headquarters to countries that have even lower corporate tax rates, but it's not nearly as bad as under current law, where we have the highest in the developed world by a long shot. As I mentioned, the replacement for the corporate income tax here is border adjusted. It's destination based, does not fall on the export, does fall on the import. We'll talk a little bit more about that later on if we have time, or we'll put that off till next week. It's one of the controversial features. And it caps the tax rate for pass-throughs at 25%. Unlike the Nunes plan, which has both the corporate and the pass-through rate at 25%, the blueprint has a slightly smaller rate for the corporation than the pass-through entity. And as I mentioned, if you take account of the taxes on the shareholders and combine that with the taxes on the corporations, that boosts the corporate rate, or the tax rate on corporate earnings, and brings you more into line with the pass-through rate. In fact, under the blueprint, it would put the combined rate nearly at the top rate in the individual side of roughly 33%. So 25% is still a break for the pass-throughs relative to perfectly equal treatment vis-a-vis the C corporation. Now, the economics of the plan are rather striking. We calculate it would boost the growth rate of the economy by almost 1% for about a decade. We'd end up with about 9% additional GDP, which goes a long way toward a fully neutral tax system, which would be somewhat nearer the 10 to 12% range. It raises the level of capital investment by about 28%. It lifts wages by almost 8% and creates almost 2 million jobs. It would lose about $2.4 trillion in revenue over 10 years in the budget window on a static basis, not counting the growth. If you count the growth, it would lose about $190 billion in revenues over 10 years. And you would find that before the end of the 10-year period, the numbers would turn positive. That's the only way you can get that number that low over the 10-year window. You have to have some major losses up front, but then you have to have some surpluses near the end. And the provisions that do that are the expensing due to the growth and the fact that its costs are front-loaded, and the interest change, which starts out only on the new loans and builds gradually over time, giving you revenues in the out years. The net 10-year economic impact in this chart kind of more dramatically shows you the sources of the growth. The net growth of about 9% is over half accounted for by moving to the expensing provision, which dramatically lowers the cost of capital and expands the capital stock by about 28%. The lower corporate rate comes in next. And then the brackets, the reduced brackets and rates come in third. Repealing the estate tax yields almost 1% of growth over the decade. Now, that tax yields so little revenue, and getting rid of it gives you so much growth that on bang for the buck calculation, it's probably the most pro-growth thing in the plan. Then you've got the rates for the pass-throughs and the change in the treatment of capital gains, which slightly lowers the tax we're currently imposing. The expensing component of the blueprint is the most powerful in terms of size and total impact. It's responsible for over half the growth, over 5%, raises the level of capital investment by 16%, by itself creates about 1 million jobs, lifts wages by about 4.5%. It loses about 2.2 trillion in revenue over 10 years static. It loses about 881 billion in revenues over 10 years after accounting for growth. You can see that's a very small number compared to the 2.2 trillion. That means that toward the end of the period, it's running surpluses. Now, it raises the revenue and reduces the deficit longer term, even after accounting for interest on the borrowing you have to do in the first few years to help pay for this initial bulge in the write-off. The top line here in blue is the dynamic revenue that you would expect to get just from going to the expensing. You can see that the revenues build after an initial loss and cross over the zero line about 7 years out or so. And compare that with the purple line at the bottom, which is the static revenue assumption, where the expensing costs more initially because you're still writing off some old equipment as well as the new. But even after you're done with that, it's still losing money unless you take the growth into account. The green line in the middle knocks down the revenue effect by the anticipated amount of extra borrowing you would have to do up front if you didn't find some other offset for this provision. It's one of the very, very few provisions, along perhaps with the estate tax, that is going to pay for itself long run, even if you take account of the borrowing needs. Now, the budgetary impacts are important to consider because you can't simply legislate a tax reform plan, no matter how simplifying or streamlined or pro-growth, without taking account of the budget effects. On the left-hand side of the chart, in the red and gold, we have up top, full expensing initially costs you about 2.2 trillion static, the territorial a tiny bit. The rate cut on the business side will cost about 1.8 trillion, and the pass-through rate reduction about 0.5 trillion. Now, where do we get our money back? The dynamic revenue from the growth, and again, this is just over the budget window, not counting surpluses beyond it. The dynamic revenue recovery is about 2 trillion. So that's only about 40% of the total. And the border adjustment provision gets about a little bit over 1 trillion. And the interest expense provision, where you're not deducting the interest on new loans, almost another 1.2 trillion. The two combined more than cover the expensing costs. And then you have other base broadeners and the deemed repatriation provision of the blueprint, where the past profits that would be taxed if you brought them back are deemed to have been brought back and taxed at a low rate. So it's not a major penalty on companies that may have already reinvested the money overseas. The border adjustment provision and the interest expense provision are somewhat controversial. I'm sure you've run into this. Exporters are glad to see a border adjusted tax, but importers are not, and they're afraid it will raise prices. Probably wouldn't. but Kyle Palmer will get into that next week. We won't get the explanation for that this week. The interest expense provision is frightening the banks because they're afraid they're going to lose business if people use more equity and less debt. That wouldn't be a problem if we stopped taxing the interest on the lender and didn't impose the double tax at the other end. If you simply flipped interest completely and took it entirely out of the tax system, and it were not deductible, but the lender weren't taxed, interest rates would drop to the after-tax levels, because there'd be no tax on the interest and they wouldn't have to charge you more to pay the tax. And then the use of interest would be just as attractive as it is now. But because we are not doing that in this plan, it would be less attractive than it is now. So the banks get nervous. But if you took these out of the provision, then certainly on a static basis, the bill would look like it had a big revenue hole, and it would become more difficult to pass. So you have to consider what you would want to do to perhaps replace those with some other revenue raisers. Now, the problem there is you have to find revenue raisers that are relatively harmless for growth, because these provisions don't do too much to damage the growth rate, and they bring you in a lot of money. You'd have to find something equally efficient at raising revenue without harming your growth objective. This is the budget impact of the full plan. Tax cuts of about $8 trillion over the budget window. Growth bringing you back about $2.5 trillion. That's only about a third. I overstated its power. The base broadeners would bring in a little over $5 trillion. It would lose about $192 billion over the decade. Considering the wage growth that's inherent in this plan, that's a very small price to pay. Now, there are alternative revenue offsets you can look at. Some of them are attractive, some of them are less attractive. I've just thrown a few together. If you flipped the treatment of saving plans so that all of your currently deductible pensions and IRAs and 401ks would have to be roth-style, where you don't get a deduction for what you put in, but you don't pay tax on what comes out, in the 10-year window, you would get a fair amount of money. It would, at least temporarily, lift the revenue stream. Then later, when people were withdrawing it and not paying tax after they retired, then you would not get as much revenue back then in the out years. This solves part of the short-run problem with the budget window deficit, but it gives you less oomph later when you might want to worry about the Byrd rule in the Senate and having things be taxed and giving you revenues past the 10 years. I believe that provision was in the Camp plan. You could raise the payroll tax cap to raise some money. It would bring in quite a bit. But if you didn't want to then simultaneously have to pay higher Social Security benefits to the upper income people who are now paying taxes on more of their wages, which would normally increase their Social Security benefits, you'd have to change the benefit formula not to allow their Social Security benefits to rise as a result. You also might face the problem that some members would want to save that for eventually reforming Social Security to keep the system from running out of money in the decades ahead. They might want to use that provision then instead. Then the other thing you might do in dealing with the immediate expensing of buildings, you have a very large lumpy upfront deduction. Well, you could stretch it out over time, but if you did pay interest and cost of money on the deduction so that it rose over time to maintain the same present value as immediate expensing, you'd get the same incentive to put up the building, but the revenue hit would not come now, it would come later. This again might run afoul of the Byrd rule, but if you're worried more about the short-run deficit consequence, you might use this idea, which is called neutral cost recovery, instead of the immediate expensing on the structures. Now, in fact, the blueprint allows this, because if you have a net operating loss due to a big deduction immediately, when you use it later, they do pay you interest plus cost of money. And this would just be making that, instead of an option, mandatory for the structures. You could also start phasing things in. The Kennedy corporate rate cut was phased in over a couple of years. back in the 60s, as was the acceleration of the write-offs. But they were phased in over just 2 years. If you start phasing things in over a very long time, you save some money apparently, but you can also delay the incentive to do the investment, which may stall the growth for a period of time, or even make people wait to put an asset in place another year to get a better treatment. And you can actually make things worse initially in the economy rather than better. So that's kind of risky. But there are things that you would have to consider if you're going to start saying, well, I don't like that provision, let's try and get another one. The committee took a lot of time thinking about this, and you might not want to try to second guess them too readily. Next, we come to the President's plan. Now, the new release of the plan was just basically one sheet of principles and broad goals. It wasn't a whole detailed book. He had more information on a plan during the campaign. Now, we can't model the current one because we don't have enough information about it. In particular, we're not quite sure what brackets he has in mind for the rates he specified, which is kind of hard to model if you don't have that information. Anyway, he would suggest a 15% rate for C corporations and pass-throughs, both, same rate, much lower. He does not have full expensing. In the campaign, he suggested, well, he'd give expensing to manufacturing on their equipment, but only if they gave up the interest deduction. Now, equipment in manufacturing is a big number, but it's small compared to the investment we make in structures and other kinds of equipment outside of the manufacturing sector. So it was only a small part of the investment, and it had this offsetting provision in it, which did not apply to other types of industries. So it really was not a major boost of growth. He has three brackets of 10, 25, and 35, but we don't know what the brackets are. Higher standard deductions. He would get rid of most personal deductions except the charitable contribution and the mortgage interest deduction. And apparently no other offsets. The broad-based change in the border adjustment, the broad-based change in the interest deductions, these are not in that one sheet. So these major cost savings are not in the plan. He does also have a very much expanded child credit. Now, we can't model this, but we did at one point model the plan that he had during the campaign, which was, again, a 15% rate for C Corps. It wasn't clear he was going to extend it to pass-throughs. In some versions he did, in some versions he didn't, and we ran it both ways. In the new sheet that he put out, he really does appear to extend it to pass-throughs, so I'll just give you the numbers on that. Again, limited expensing for manufacturing equipment if the firm gives up interest deductions. Three brackets. His brackets were a little bit different in the original proposal. They're a little bit less generous at the top now. Or no, excuse me, they're a little bit higher at the top now and at the bottom than they were in the campaign plan. He would have capital gains rates at 0, 15, and 20% with the same brackets as the three he has for the ordinary income. Remember, we have a zero tax rate now if you're in the 15% bracket and you have capital gains. And he would continue that zero capital gains rate even under his revised plans. He has a higher standard deduction, and again, most personal deductions are gone except charitable contributions and mortgage interest, and again, an expansion of the child credit is mentioned. So I think there's kind of an overlap between the campaign proposal and what he's talking about now. And when we model that one, assuming the 15% rate is passed through on pass-through businesses as well as the C corporations, we got growth of 8.2%, which is impressive. It raises business capital stock by about 24%, wages by about 6, 2.2 million jobs. But without the offsets, without the pay-fors, when you have all the goodies and none of the medicine, it ran up the tab. It was almost a $6 trillion revenue loss over 10 years, static, and even with the growth effects, it loses almost $4 trillion in revenues over the 10 years. So it's more expensive than the blueprint and has a bit less growth and a bit less capital formation than the blueprint, primarily because the expensing provision is not broad and because on the budget side because he doesn't have the interest flip where you lose the deduction. I'm going to take 5 minutes, since we started late, to talk a little bit about the business activities tax, or the border adjustment feature in the blueprint, which is causing some concern. Kyle will go over more of it next week. Economists have studied international trade more than any other area in economics. It goes way back to when the feudal lords in Europe were trying to amass gold hoardings to pay for their mercenaries to invade their neighbors, and they had very high tariffs, and all kinds of bad things were being done in cross-border trade back in the day. So we know now not to be mercantilistic, but trade trade is one of those confusing things where even economists get confused. In the 1930s, it was assumed that if you were running a balance of payments deficit, it would put downward pressure on your exchange rate to stop you from running a balance of payments deficit. The trade balance was driving the exchange rate, and everybody focused on that. It wasn't until we got through the Depression and the capital controls during and after World War II, and we began resuming a more normal situation where countries can freely invest in each other, which was the norm in the 1800s, by the way. But it had broken down in the Depression and the war. By the 60s and 70s, it became apparent that international capital flows were again huge. 1 or even 2 orders of magnitude greater than the trade flows. And economists at the University of Chicago who studied trade began saying, you know what, we can't do this business about this devaluing your currency to improve your trade balance to avoid this or that issue. The capital flows are what are driving things. If you're growing rapidly and your neighbors aren't, then you're going to be importing more, and you're going to be attracting capital from the rest of the world, helping you grow, because your opportunities are better. If you have a capital inflow, you're going to be having more foreign currency made available to you to buy things with abroad while you're doing your growing here at home. So growth tends to lead to a trade deficit, a bigger one, but it doesn't hurt growth because it's the result of growth, not something that happens exogenously to prevent it. These ideas were rather new in the 1970s, or at least renewed. They were fairly well understood in the 1800s, but by the 1970s, they were again revolutionary. And Harry Johnson and Robert Mundell were ridiculed for these views. Johnson died too young to get the Nobel Prize. They eventually had to give it to Mundell because all his predictions came true. The key thing to note there is that Johnson and Mundell were both Canadians. In Canada, most of the population lives within 100 miles of the US border, and a huge amount of their GDP flows across international borders. Here, we tend to ignore the international sector because the domestic sector is so large. So even though we're the world's largest trading nation, and certainly the largest financial center, we tend to ignore the trade sector, and it's often badly understood. So studying what the economists now think about such things as border adjustments, you will find conflicting views, but generally speaking, at least the people who admit the world is an open economy tend to come up with a unified set of views. So why did the Ways and Means Committee include the border adjusted tax? It broadens the tax base and raises about 1.1 trillion in a less economically harmful way than many other revenue sources. Why does it raise revenue? Because we're running a trade deficit. Exports are smaller than imports. If you put a tax on imports and forgive a tax on exports, you're getting the tax on a bigger thing than you're forgiving it on the smaller thing, right? We've heard a number of criticisms of this provision. What happens when we begin running a trade surplus in the United States in the future? Then all these revenues go away. I have a secret to tell you. If you're looking at a 10-year budget window, that ain't going to happen. We're not going to turn the trade deficit around that quickly. In fact, if we start growing much faster than the rest of the world for a decade, we'll probably have a bigger trade deficit, and it'll bring in even more money. But it won't hurt the growth, because it will be the growth turning the deficit, not the deficit stopping the growth. The border-adjusted tax does a great deal to prevent shifting income into a lower tax jurisdiction. The games playing you can play with what you're charging your foreign subsidiary, getting less from them when they buy from you to lower your U.S. profit and make their foreign profit look bigger so that they're paying tax in the lower jurisdiction. This is called profit shifting. In a tax system where you're not taxing the export anyway, that all goes away. There's no point in shifting the revenue abroad. You wouldn't be paying tax on it if you had it here. Better here than there. And the same thing about moving intellectual property back onshore rather than sending it over to your Irish subsidiary. And it greatly simplifies the business tax system. But there's another idea, and that is, here's the slide I should have switched to, about broadening the tax base and raising revenue, and protecting against base erosion by improving business incentives to earn and report income here, and the simplification point. Now, let's have some reasons why we shouldn't be claiming the border adjustment is a good thing. It is a good thing for the other reasons, but people tend to turn to another explanation for why they like it, which has far less intellectual support. Border-adjusted taxes don't cure the trade deficit by giving you an advantage over your foreign competitor. This is a myth. The easiest tax to look at that is border adjustable is the VAT. VATs don't normally affect trade balances. And in particular, the fact that Europe raises some of its tax revenue by using the VAT doesn't mean they have an advantage when they try to sell here. Our problems with manufacturing are due to our own policies involving excessive regulation and taxation, particularly on the poor depreciation write-offs we give. Also, the trade deficit is primarily determined by the net capital flow. If capital is flowing out, we're lending money to foreigners to buy things here, and we tend to run a trade surplus. If capital is flowing in, they're lending us money, and they have given us more foreign exchange to buy more of their things, and we tend to run a trade deficit. The capital flows are what drive it, not these taxes embedded in products idea. And indeed, a pro-growth tax reform would attract capital, raise the dollar, and boost imports. This happened between 1981 and 1985. And indeed, the capital inflow helped cover the deficit from the '81 Tax Act. And I was told, I don't know if I told you this story, I was told when I was working at the Treasury that we were crazy, that projecting a $100 billion increase in the deficit in the first couple of years of the '81 Act would be impossible to fund and still have the growth we were showing, because we wouldn't be able to buy the bonds from the companies to give them the money to do the investment because of the need to borrow our own savings to fund the federal deficit. It'd be crowding out. And I said at a panel discussion, I said, well, we're assuming basically a capital inflow of about $100 billion a year for a while. And I was told by someone from a major modeling company in New England, you can't do that. It's already a $100 billion capital inflow. The Europeans aren't going to double their lending to us. I was confused for a minute. And then I said to him, Roger, that's a net figure. See, the Commerce Department labeled it the capital inflow, but it was the net capital inflow. We were actually lending abroad about $450 billion a year back then, and foreigners were lending about $550 billion to us, and the total was about $1 trillion, and I was kind of redirecting maybe 10% here. It wasn't a big deal. Roger had forgotten that. He turned beet red, and the room broke up because they were all New York bond dealers who knew all about this stuff. I hadn't meant to embarrass him, but capital flows are huge. They're in the tens of trillions of dollars, and I beg your pardon, they're in the hundreds of trillions of dollars, and the trade flows are in the tens. So they dwarf the trade flows. And anyway, in the event, U.S. bank lending abroad fell from $120 billion in 1982 to $19 billion in 1984. The banks just simply stopped lending abroad and redirected their lending to the United States, and just that one little category of lending solved the whole problem without anybody telling anybody what to do. So these things have to be looked at from the point of view of the capital flows, not the trade flows. But what happens with VATS and trade? The easiest way to see why you might not expect it to have much effect on the trade balance, in addition to the fact that a VAT by itself won't affect the capital flows, is that suppose the foreigners put on a VAT. It will raise the price of their imports and their domestic goods equally because it falls on both their imported and domestic product. So their citizens don't have any reason to change their behavior as to buying foreign and domestic goods because the tax is the same on both. On exports, well, it's not imposed on the export to the United States, but we don't impose it either. And so we haven't changed the price of domestic and foreign goods here. So our consumers don't have any reason to change what they're doing. So why would you expect a big change in buying habits? You shouldn't. Another reason is that the VATs in Europe are additional taxes on top of their payroll taxes, their corporate taxes, and their income taxes, and all their other taxes. There's as much tax in a European product coming to the United States without the VAT as we have on our own products here. It's another reason for thinking why it's not giving them an advantage. So VATs by themselves don't normally affect spending habits and capital flows, and you shouldn't expect it to mess around with the trade balance. Now, the business activities tax or the destination-based cash flow tax in the blueprint isn't a full VAT. It applies to the profit side of a sale, not the labor cost side. Remember, value added is labor plus the returns to the capital in the production of the product. And the VAT, or the border adjustable tax, applies to the profit side, but not to the labor side, which is continued to be deductible and isn't subject to this BAT. Now, that may lead the World Trade Organization to become a little bit upset because, in effect, we're giving a tax break to our labor on the export that they're not getting out of their VAT, which falls on their labor. So it's not a full VAT. That may cause them some grief. And the other reason they may complain is that, according to their rules, direct taxes on income are not border adjustable, but sales taxes, which are indirect taxes, are border adjustable, and they're going to call this they're going to call this an income tax, not a sales tax, because they're using it to replace the corporate income tax. And what the heck do we think we're doing? And that's all silly, because you know from supply and demand graphs that taxes are shifted here or there according to how the demand and supply conditions are, not according to what you call them. So I wouldn't worry about that one, but they might have a reason because it's not a full VAT. Nonetheless, we shouldn't expect the border adjustment of the portion of the tax that we're replacing the corporate tax with, and the pass-through tax on exports as well, to do very much because it is not going to be affecting the capital flows. I won't go through it in detail, but I have, again, the VAT is not a full VAT. We have to have a balance in our accounts. This is not just an accounting identity, although it is in the Commerce Department figures. But what we sell has to equal what we buy. When you include the sale of IOUs and the net borrowing in the total purchases. So when we sell things abroad and borrow abroad by selling an IOU, we get the money to buy everything that we buy, which includes imports and any foreign investments that we might want to buy, any foreign bonds or any foreign physical assets. And the two sides equal each other. They have to. If they didn't, there'd be more people wanting dollars than selling dollars. The exchange rate would move until the two values came into adjustment. Otherwise, the market would not clear. And the market that clears the fastest of all is the foreign exchange market. Now, if I take that bottom line and I rearrange terms and I put the goods on the left and the financial stuff on the right, exports minus imports, which is the trade or current account balance, equals the difference between financial assets, items that we have sold, that is, we've borrowed from abroad, minus what we've lent abroad. If we're importing more than we're exporting, we're borrowing the difference, and the two sides are equal. And a trade surplus means a current account, a capital account outflow or deficit, and a trade deficit means a capital account, money being lent here, inflow. And they are equal and opposite, and they have to balance. And the difference between the two financial transactions is really going to be driving the export and import side to a considerable degree because they're much larger, and they do tend to set the exchange rate. Now, if you do have a change in exports and imports, if people suddenly become very attracted to US, let's say, fracking, and foreigners want to invest in that, we have a change in the terms of trade and you get an effect. But you're not going to get it just from the sort of tax changes that we're talking about here. Well, anyway, I'll end here, and we'll go over more information about the blueprint next week and talk again about some of the objections to it and some of the arguments for it and against it, and possibly some, things that could be done to improve it. But if you have a chance and you want to raise questions about the blueprint or any of the other tax plans that have been submitted by the members, please make a list of them, and we'll try and answer your questions next week. Thank you for coming.